See it. Hi, everybody. We're going to be starting right on time today. As usual, welcome EWC webinar. We're really, really happy to have you. We'll be starting in a minute. Oh, Carlos, you know what? Bring up the chart so we can show everybody that we'll talk about that when Chris's time is done.
I got it on deck.
Thank you.
You want me to post it now?
Yeah, that'd be great.
Okay, cool.
Welcome, guys. We'll be starting in a minute. In the meantime, I'm going to again explain Global Pool. I know some of you have already, hey Cesar, I know some of you have already seen that you have received your Global Pool emails and your country is definitely in the Global Pool. So prepare. That means you will have 3 deliverables if you are idea and early stage, 2 deliverables if you are growth stage. So please check out, we added an additional 9 countries to Global Pool. So we have to make sure you guys are thinking that through, okay? We'll be starting in 1 more minute with our very, very, very special guest today. And let me remind all of you, if you have questions, you can put it in the chat if it is EWC or for our guest. You can also put in the Q&A. The Q&A allows us to be able to answer them a little bit more directly to your question so that other people can see the question and answer together. All right. All right, Carlos, go ahead and pull that down and we'll get started. Thanks. Hi, everybody. I'm Susan Amott, and I'm really thrilled to invite you to another wonderful day of learning with a great special guest and friend of ours, Chris Schroeder. So for this EWC webinar, we wanted to do something really big thinking because, as you know, many of our countries are opening up again, and that means bigger thinking about challenges and opportunities, global scale. And as you know, the whole premise with EWC is global connectiveness, meeting each other, finding each other, and supporting each other. I know it's a competition, but it's really about making the connection so you find those partners, suppliers, customers, even with your other contestants. So today we have Chris Schroeder. He has been an emerging market expert investor for many years. He wrote the definitive book explaining what's happening in the Middle East as far as investment opportunity years ago called Startup Rising. And he's the founder of Next Billion Ventures. I think one of the coolest things about Chris, though, is he came into the investment world after decades of experience doing really important impact things on the entrepreneurship side. As an editor, he knows the digital world, but most importantly, he's just a real authentic person who brings a reality check to whatever he's talking about. So today's going to be a fun conversation with Chris. I'm really excited to see your questions because he's been all over the world helping people build value, from entrepreneurs to titans of industry. So I think today's conversation is going to be really exciting. And Chris, thanks for finding the time to join us today.
I'm so awesome to be with you guys, and congrats on all you guys are building.
Thanks. So I really want to start with thinking through how can we look at all of the different opportunities going on in different continents, different regions of the world. I know you're out there in the world, on the ground with entrepreneurs, investors. What can you share with us about any nuances of how differently different regions are viewing investment opportunities, trends in investing, and kind of most importantly, risk aversion? What are you seeing on the ground?
I think one of the biggest surprises, I've been now going to emerging markets well over a decade and been investing in them for about 7 years. And probably the biggest surprise I have is how much is actually shared among them, not so much what is different. And so what is very interesting is that people often ask me, what is the hottest new technology? What is the least understood? tech trend, particularly coming out of COVID. And what I tell them is that there are lots of really interesting things in the tech, but the thing that's not understood is the near universal access to it. So the fact that almost any country that's on this call right now, 60, 70, 80% have a supercomputer in their pocket and are engaging in a different way is a very, very powerful phenomenon. And what compounds it is that the kinds of challenges, particularly entrepreneurs face in rising markets, doesn't matter what geography they're in, doesn't matter the language they speak or their heritage and everything else, 70 or 80% of what they navigate are actually much more familiar among themselves than with Silicon Valley or New York. And that's not to say that a New York or Silicon Valley company doesn't have some relevant bearing to it, but I can sit with a woman from Jakarta and a woman from Cairo and a woman from Sao Paulo who are all building an SME lending business. And literally 70% of that conversation is about last mile logistics, navigating regulatory environments that change all the time, educating a consumer base that has never had a credit card, may not have even been banked, but now has a sort of education about how to use it. And they have a similar conversation. This hit me like a 2x4 back in September because I spent 3 weeks in China. And one of the cool things that I did there was I literally sat in a bunch of meetings with about 15 growth stage entrepreneurs from Latin America, Africa, and Southeast Asia with their Chinese counterparts. And I realized within 15 minutes that most of what they were talking about would never have come up in a Silicon Valley conversation. And China, being a former emerging market and still in many of its cities emerging still, spoke the language perfectly. And so this shared learning and shared dynamics in sort of emerging market to emerging market, I think is actually a very powerful thing, not only from a learning perspective, but I think letting many of your entrepreneurs will look for global opportunities in other rising markets and not just the traditional, hopefully one day we'll go to China or the West.
I think your comment there was really important because it's different from the Silicon Valley conversation. How do we help some of these markets rethink the obsession with the Silicon Valley mindset? Because, I mean, there are pros and cons to it, but it comes up in almost every conversation. And I think it's actually really dangerous because so many of the cool entrepreneurs we get to work with in emerging markets, they're just figuring it out, knowing that there's not that investment to test with. You know, they're using their own risk capital instead of somebody else's. And I really think that this is a major challenge that because it's still Silicon Valley, so many companies get lured into this thing instead of just solving a customer problem and going with it.
I think that one, that's absolutely right. And I think secondly, the best thing an entrepreneur can do is tie herself to the mast of what problem needs to be solved on what terms that are unique to a different market. And by the way, historically, there's been that Silicon Valley overhang, which is real. And now, particularly in Southeast Asia, but I even hear it sometimes in Latin America, there's a China model that people are thinking this is what they want to do. And look, there's plenty of learning to be done. There's plenty of shared experiences. But I think to my earlier point right now, only you as entrepreneurs understand your markets. You understand the unique nuance that actually not only is important for you to be successful on your own terms, but also will be one of your great competitive edges when, frankly, a Silicon Valley or a China company may come here. In terms of people's perception, I think it's a generational thing. I think that there's still a bunch of people who think that where the next Silicon Valley will be is the right question. I don't think it's ever been the right question. I think what's happening in Sao Paulo is very, very different than what is happening in Dubai, and is very, very different than happening in Cairo, and very different than what's happening in Berlin. Doesn't mean that there's not great shared learning, but it means that people are now realizing, one, they can build companies on the terms of their market, but as importantly, if not more importantly, they can build product for those countries and unique needs. And as long as your North Star is about meeting those needs, who cares what other comparisons outsiders make? You'll be just fine.
So I'm going to ask a series of questions around kind of preparing for different funding rounds. But first, I want to start with, what are you seeing as far as when successful companies are able to bootstrap, and sometimes for years and up to a place where they're ready to scale from there? What do you see as the skills? What are they focused on to make that happen?
So they, shared universally, and obviously with nuance, market to market overall. When you are at the seed stage, like when you're getting that first money, the term you use is the right one. It is bootstrap. It is spending every dollar like it's your own. And it's about really sort of convincing for your market and for you a successful product that actually has a market fit to it. Because the reality is at some point, unless you're fortunate, and many companies are fortunate, you will raise more money subsequently. And I think a lot of times people forget that when they're at the seed round, and even in the earlier rounds like the A round, that this may in fact be a step on the journey. And so they get all excited about being very, very focused on having this thing in the present. And they're not realizing that this is a very good step of what's coming next. At the seed level, this doesn't happen as much, but very soon thereafter, people, for example, will get very excited. Entrepreneurs will get very excited about, getting a big valuation. Well, lo and behold, if you get a big valuation, that might be good for your equity share. But if you don't perform and your next round is a down round, this could be actually have a multiplier in a very competitive market, terrible thing. And so there's just a balance in saying, what money do I need now to get through the next year, maybe 18 months, to be able to prove the success that I want? And I want to get up in the morning and go to bed at night, proving that case, keeping in mind that there's going to be some chance to grow, that I'm going to have to bring other money in. And I want that to be just a completely perfect case for the next go around. It's never smooth, but it will be easier when you have that kind of sense of guidance and that sense of perspective going through the process.
So what do you look for as an investor when you're evaluating and diligencing a seed stage company? They don't have a track record yet. So what are you looking at?
At seed stage, at A stage, and at almost any stage, it begins first and foremost with the entrepreneur and the team. And in fact, I drive some entrepreneurs crazy because when they come to meet me, they're all ready to go, right? They got their deck and their plan and they got their speech and they're kind of like in this mode. And I actually I almost never get to their deck first time I meet them. I want to understand, why are you doing this? What is the problem in your teeth that you have to solve? There are 100 different things you could be doing with your life right now. Why are you doing this? Who's your co-founder? Why did you pick her? What was it matter to you overall? How are you thinking about a team? And you get all sorts of different kinds of answers to the questions. And it's not that I'm testing them, but I'm just trying to get a sense of who they are, because the reality is, particularly at the seed stage, even the best laid deck is going to get hit in all sorts of directions that are going to make those entrepreneurs have to change based on the data and our market realities. And so I want to see, does this woman have the stick-to-itness? Is she really in this? Is this something that she wants to solve with her teeth? Or is this sort of like something that's kind of experimental to her? Has she thought about things? Is she humble enough to know what she doesn't know? And to be able to say point blank to me, I don't know the answer to that question, but here's my thinking about it right now. All these dynamics make me want to dig in deeper. And then, it goes from there.
What are you thinking as you're diligencing them past the deck? Because there are so many things that can go wrong. I'd love to hear some stories from you about, where you've seen companies make mistakes. You're already interested in them. You have good chemistry. You like the idea, but that diligencing might be a week. It may be months. What does that look like?
Well, at a seed stage level, diligencing will never be more. And there are many quite successful seed stage investors who don't diligence at all. And in fact, even at Silicon Valley, later stage, at a portfolio level, people will say, you can get talked out of things, and that sometimes could be a mistake. I happen to be very religious about reference checking and doing due diligence, but in an early seed stage company, maybe I would do a couple of market tests. I might do a couple of conversations with a potential customer that I may know for my own background. But for me, it's still about the entrepreneur. So I really just want to understand what's going on, and you can be surprised. So I'll give you an example. There was a co-founding team that pitched not too long ago, and the idea was good. They were great. They knew each other since kindergarten. Okay. Literally kindergarten. So they grew up together. They went through all sorts of institutes together. What could possibly go wrong? They know everything about each other. We're like 6 months after they took the money, they were at each other's throats. Like there were all these kinds of dynamics of things that pissed each other off since like fourth grade that all came to bear in the asset. And so I should have pulled on more strings to get kind of an understanding of what were the dynamics between them and had there been tension in some previous things they've done before. And little things like that I think would have been very powerful. The mistake that sometimes you can make at the seed stage, but also can be done a little bit better, is that momentum matters in a deal, and I think that matters throughout. And what I mean by that is, if you get all fired up and you have a good presentation and you've articulated me, you've got other investors set up and ready to go, and the deal starts to drag, and I start to realize you were kind of spinning me, you were overselling the reality of your circumstance. That's actually a huge yellow flag to me, because if you'll do this at this stage, you may do it when you run into problems, as you inevitably will once I've actually invested in you. And so there's a company that I looked at not too long ago where I thought the entrepreneur was terrific. I thought the market idea was hard, but I really, really liked her and thought about it. And she made a lot of representations of where she was in the track to fundraising. And for reasons, many of which outside of her control, but some of which I think if she could do it again, she would have conveyed in a different way. It just dragged and it dragged. And at some point, I just sort of said, there are other deals to look at. And all the investors you talk to, whether they're friends and family, or certainly when you start talking to kind of real investors, they have so many things coming at them that it becomes very easy for them to get distracted and move on to something else if you have sort of not held that sense of focus in follow-up that is essential not only in a fundraising mode, but is also an indicator of what kind of follow-up and execution you will do when you're in the operating side of what you're building.
And then what about companies further along? So Series A, Series B, there's some history there. You have data on where they've been and where they're going. What does that diligence look like?
So it's different people come at it in very different ways. And there's this old adage in the Valley, which has an element of truth, I think, sadly, which is almost sometimes you're in better shape pitching the idea than pitching the actual performance because you're still in this ethereal stage where everyone thinks everything's going to be up and to the right. I don't look at it that way, quite frankly. I like looking at companies a lot in the A and even in the B stage, because not only do you have a sense of the performance and trajectory, you have a sense of what they've learned about the business. And you can get a really core sense in a conversation with the entrepreneur about where they're going and why and how they're thinking about it. Have they learned from this experience that they need to do more of the same? Do they feel like they've built a platform that now they should be leveraging into other services? Is that a distraction or not a distraction? How are they thinking about the use of proceeds, which is really becomes foundationally different at an A or B stage where you're now raising a significant amount of money, giving a significant piece of your company perhaps. And now what you do with that money matters, like how you're thinking about talent and how you inspire them. Is your culture ready to go to the next level? Is this a company that is going to be going very nicely and could be a great outcome for an entrepreneur? Or as an investor, is this something that I look at that's going to have a multiple fold impact that I will view in a little bit of a different way? The questions become more concrete because one, you have more evidence, not only evidence in the actual hard performance of the company, but how the entrepreneur is thinking, how the entrepreneur is doing with their co-founder, how the entrepreneur has built the team, what kind of talent has she attracted. I actually find it fascinating. I love those kinds of conversations because at one level, they're one part due diligence for sure, but they become kind of mentoring conversations. They become kind of a sense of what it might be like to be on the board if that were to happen. And those kinds of dynamics are also hard to measure or articulate, but I think are very powerful dynamics.
I would love for you to spend some time on challenges you've seen, because this has actually happened to companies in programs we've run where they're early investors that were local and not necessarily really professional. The term sheets really weighed down decisions of later investors that had more professionalism and more of an international mindset, even being able to come in and do follow-on rounds because there was some mess there to clear up. Do you have any stories and guidance for our companies here about those early, local investors and how to manage that process a little better for later round and attractiveness for international investors?
Sadly, too many. What ends up happening, this is a little bit less of the case in America, and it's becoming, I think, less of a case in the other markets that I'm in, but it's still there, which is that sometimes early investors I can't describe it any other way, it's term sheet abuse. They were kind of the only game in town. There wasn't a lot of other money available. They are former real estate people or former banking people, and they look at it as a victory to take as much equity from an entrepreneur as possible. And those are really tough situations to come into because unless I can talk that investor to either get rid of some of the shares in a secondary or rethink this in a company going forward, at the end of the day, I have to really wonder whether the entrepreneur is stuck or whether the entrepreneur will have the incentive and her team will have the incentive to take it to the next level. And so what's the lesson? The lesson is at one level, all of us, particularly in the earlier stages, we need money. Like we can't necessarily call the shots. We hope that we get more than one term sheet, but often we cannot. Very often the earliest stages, friends and family anyway, and usually that's pretty safe because they're just kind of in it for the ride and supporting you. But it begs a fundamental question I think you ask at every round, which is not only how much money do I need and what do I want to do with it, but what kind of money do I want with me? Am I looking for someone who's going to be a real help to me, or do I want them to be just quiet money where I don't have to think about it? If they're going to be a help to me, can I really define what that help is? And what kind of terms am I willing to accept as a part of that help? And honestly, if you cannot be concrete and that help really moving you multiplier effects, and there is a worry that they will be aggressive with you in a term sheet or be a problem for you on the board, it is worth a real gut check and even possibly taking the risk of taking more time to find people who can surround you who want to get up in the morning and go to bed at night to help you win. But this does happen, particularly in other markets, quite frequently. And it gets very messy because the next round doesn't want to recap. The next round doesn't want to fix these problems. But on the other hand, if the company is that good, we'll figure it out.
So when I think about the attractiveness of how the money is going to be allocated when you're getting into those later rounds and companies are looking at maybe going regional or trying to, take on the world, I would love your thoughts on finding that balance between quite a few of the entrepreneurs we work with. We focus on data-driven entrepreneurs who are super into testing and validating and experimenting. But it's so much more attractive sounding to want to we're going to take on these 5 countries in this quarter. And that big vision just always sounds so awesome. Help us kind of walk through what makes the best sense, because some of the companies we're talking to, we've seen some data-driven analysis of their growth plans, but how do you balance between making sure it sounds like you want to take on the world and that there's this big global opportunity while still sounding like a rational human being that understands the work that's going to need to be done to make it happen?
It's a very hard question, and it's more art than science in a way. But let me tell you a question that I ask entrepreneurs a lot when we're toward the later part of whether or not to fundraise with them, because in a way it's indicative of something. It's not dispositive, but it is indicative of something. And often I will ask a entrepreneur who's all fired up and gave me the story of everything else. I'll say to them, okay, let's just say hypothetically, 6 months from now, an operator company in the business offers you $50 million cash on the barrel for your company, and you like them, you'd be happy to spend 2 years with them, and what would you like to do? I have a lot of entrepreneurs who say, of course I would take it. It's great for me, it would be pretty good for my early investors, not a bad return, and everything else. And this is where I'm cautious about it, because at one level, that's all factually true. But that entrepreneurs also told me how confident they are. The big successful companies is an example for everything. But the famous story, of course, was at one point Facebook was offered something like $3 billion to be acquired. And literally Mark walked into his board and said, I have to fiduciarily tell you about this, but needless to say, under no circumstances will we look at this offer. And that's fine. There are many exceptions to the rule of the opposite of his success. But it actually is an interesting test mode about how the entrepreneur is really thinking about where this thing will go and why. Because then the question will always become, where will the size come from? Are you really in this for a long run to build something of value? If it's geographic, what geographies and why? When is a geography a distraction or a perfect next step for what you're trying to do? You could go into this other market right now. I totally get it. But quite frankly, you could own the existing market now, which is a very big market. Why would you do that? And it becomes a conversation. There's not one right answer, though data is absolutely instructive on why that might matter or competitive dynamics might mean. I get now from a lot of companies around the world, particularly in the fintech space, they'll sort of describe to me a wedge of their business, like I'm doing this piece of SME lending or whatever it might be. I'm doing payments. This is one I used to hear quite often. And you sort of get a feeling at some point that they actually only think that core thing they're going into will get only so big. And then they start talking about the other services that they will offer on top of that because of the data they've built in the first thing that they're going after. Let me tell you something, that could be true. Most great financial institutions offer multiple products over time, but it also is a yellow flag of a distraction. How much do you believe in the core proposition that you're offering? How much in the end is that core proposition you're offering really at the behest of future things down the line we don't even know that much about yet that you feel must layer in to become of scale? These are all the kinds of back and forth conversations that we have. And what I'm really looking for is not the black and white crystal ball answer. have they really thought about this? How are they thinking about this? Where are they pushing back? Where are they comfortable? This becomes very revealing to me in partnership with the data about what odds do I think they have of pulling off what it is that they're trying to articulate.
So if you were an entrepreneur, how do you start diligencing investors to find the right fit? Because it's not just about the money. I mean, having your knowledge and mentoring and support is worth more than your money every day. So how do I even start thinking through, okay, who's going to be the best fit for me? Yes, with money, but much more long-term, who's going to help me get to that end goal?
I think this is one of the most profound mistakes entrepreneurs make very early on, which is in a way they become in awe of or fall in love with the money. And the very act that the person sitting across the table has money and wants to give it to them, people kind of lose the perspective of one of the most important points, which is you as an entrepreneur, more often than not, understand 10 times what the person you're sitting across the table is about your business in your setting. Now, a good investor has been in similar types of areas. They have good pattern recognition, which is helpful to you, but she or he has never gotten up in the morning and gone to bed at night to really try to solve it. And so we have to, first step is just to eliminate this sense of awe, for which a corollary to that is we think that if all of a sudden we get an investment like from a Sequoia or a Kazakh in Latin America or an STV in the Middle East or a Jungle in Southeast Asia, like we've won, like this is victory. Our customers will love us, our parents will love us, we tell our friends, we raised from this great brand. And at the margins, it's a good signal. But at the end of the day, as important as the institution, in fact, much more important than the institution is the individual who is doing the investment with you and is very likely to sit on the board. None of that brand matters when you're in a foxhole and something is going very wrong and you have to fix it. Nothing in that brand helps you if you're going great, except that the best of these brands will have resources like, for example, Andreessen Horowitz does, to help throw gasoline on that fire and help you think about things through the data and through the relationships they have. But the individual is the one that is often underestimated, and that leads directly to your question, which is there is no substitute for one, checking that woman or man out, because many entrepreneurs do not. And the best people to check them out with, frankly, are other entrepreneurs. And if you're really willing to dig, it's pretty good to find an entrepreneur who maybe didn't last long with them and try to get a little bit of a perspective. Because what you really want to know is if you're betting on a certain kind of expertise, do they have it? If you're betting on a certain series of relationships, do they deliver it? If they have pattern recognition in a certain area that you're focused on, can they help you there? And do they know when to back off? Many, many board members, quite frankly, and the high caliber of them, went to business school, never ran a company, got into the right brands and got into the right institutions, and they kind of bully you around. It's like they know better than you. You instantly just don't want that as part of your life. You want someone who's going to be fiduciarily tough on you, someone that you cannot bullshit. You need to have a complete symbiotic relationship of trust at that level. But at the end of the day, you want to make sure they're getting up in the morning, going to bed at night, remembering you are the CEO, you are the founder, and their job is to do everything they can to help you until, for whatever reason, if you don't perform or deliver.
So here's a question from one of our participants. We're happy to have you guys all. Hi. Is there a rule of thumb? Sorry, I'm going to start all over again okay. Is there a rule of thumb for how much equity I should give to investors? Do you have a hard stop for how much equity that should be given at each level of the investment?
There are books written that sort of give frameworks of what happens very often. And the real answer to the question is a combination of what it is that you really need in the money and the use of proceeds and where you think it's going to get you going forward. It absolutely keeps in mind what you need as part of an incentive pool for your team. But it's pretty hard to have hard and fast rules. Looking at it from the investor side, most of them, particularly earlier on, are going to hope to have, anywhere between a 5% to even a 20% stake in whatever it is they put on, just because the math for their return analysis means that if further dilution comes, they're thinking that way. And I can't urge you enough to spend a little time learning about how investors are thinking about this stuff. In fact, if you've not read Brad Feld's book, which is about venture investing, which is very good, and then the president, Scott Cooper at Andreessen Horowitz, just wrote kind of a Secrets of Silicon Valley book. It's about 80% written for the investor, but I think every entrepreneur should read these books because it gives a sense of what they're doing that's not ill toward. It's just what are their motivation and incentives of how they want to look at things overall. But I think, look, very early on, you obviously probably at the seed stage are giving a note. More often than not, you're not even worried about giving up equity. You're kind of kicking that ball down the field until the next round. And in the next round, in the A round in particular, all things being equal, again, depending on your business and your needs and what competitive term sheets you want, you should be still in control of your company. Sometimes companies need massive amounts of capital to become massively large, and that becomes different. But more often than not, I find that companies that are on a good trajectory are able to keep control, maybe give up 20, 25% of the company even. And then the rest of it, I think, is art and science, depending what your needs are. But it's always driven by your needs. You would rather have a smaller piece of a watermelon than a larger piece of a cherry, right? I mean, it's just, that's the kind of thing you have to keep looking in the mirror and understanding.
Can a strategic consulting startup raise funds? So think about service firms. What does that look like compared to tech or products?
Yeah, I think absolutely they can. I think it's just depending what kind of investor that you want. You would not probably take, all things being equal, and there's obviously exceptions to prove this rule wrong, but you would not be going to kind of a classic VC, consumer-oriented VC, or even an enterprise VC who is looking for really hyper growth, a path. Are you $1 billion+ company or not? If you're in what's going to be a great steady business that could kick off a dividend and possibly be sold to another consulting firm down the line, that would be more almost like an LBO kind of investor or even personal investors. And this is a beauty about the time that we're living in right now. There's so many alternative vehicles beyond the funds in whatever company that you want to do. And particularly many of you from around the world know that family offices now are opening up, primary investment wings. They're not just doing real estate and publicly traded securities and 2 and 20 funds, but they want to be their own venture capitalists. Or if they see a great consulting idea and they think this company could be a 3-bagger in 4 years, of course they're going to look at it in a different way, in a way that a traditional VC would not, because that isn't as appealing to them. So absolutely, it's just a different kind of investor that you may be talking to, depending on what type of, for example, services company it is and what kind of trajectory you truly want to have in it and think is realistic in the marketplace.
I've seen some crazy acquisitions recently with, many, many times multiples that I've never seen before for service businesses. So I think it really always comes back to the operational efficiencies and the growth rate. So guys, it's about building good businesses. Don't worry. Okay, so a couple of interesting questions coming in. How do you strategically present a blue ocean strategy? So I'm wondering, I'm going to kind of rephrase it in that, what kind of data points are helpful for you to evaluate the opportunity with a blue ocean strategy? Like, what kind of research and validation can be done to help make it very clear that that team is thinking it in the right way to get you excited?
So there's sort of a continuum that I look for almost at any stage, but particularly at the earlier stage overall. Again, I don't have to talk more about it. I really just want to get a sense of the team and of the individuals. What are you thinking about it? Why is this a big enough problem for you? Again, why of all the things that you're doing? And hopefully part of your answer is a data answer. Hopefully, maybe it's a spiritual thing. I've had unbelievable entrepreneurs who've come to me who have suffered something in their family or seen something and they've just had it in their teeth to want to fix it, and the process of then going into the dynamics of it. But the dynamics then matter because it is blue ocean and it is early, and all strategic plans, end after the first day of fire a shot in a battle. But, what is your TAM? And is it a real TAM? And off-putting things is often, someone will pitch me a healthcare business or an energy business, and they'll give me a TAM of like all of healthcare. And it's like, that's not, it's just, I get why you're doing it, but it's foolish, right? Get to the essence. You have a particular need that you want to solve that you think is very big. Where is that market? What is the product market fit? And here's a very important question. Is it good enough, or is it game-changing in making someone's life better, easier, faster, cheaper, more beautiful, more efficient, more cost-effective than it was before? Because a trip that a lot of entrepreneurs have in the blue sky days is to be so convinced a customer wants this thing that they often overlook that sometimes good enough is good enough. However the customer is doing it now, they may not love it. They may want to do something different, but they may be so comfortable in the behavior that the art of changing isn't worth more money. It isn't worth any money. I don't want to have to do it. And so the TAM has to reflect that. It has to be a real TAM based on a real pain point or a real opportunity where people can say that they want it. Now, it is beautiful. Doesn't always happen, but it is beautiful in the blue ocean stage when I have people who have shown me their MVPs that are being tested with a real life customer or series of customers whose data is absolutely confirming of the very premise that they're going after. That's wonderful if you can have it. And I think is very, very valuable because then I can get on the phone and talk to them a little bit and ask them the question. And one of the questions I will ask them is not just how's the product doing? What do you think of the entrepreneur? I'm going to be saying to you in a scale of 1 to 10, how big is this for you? How important is this to you? When you have to do your budget assignment, who's making the decision to buy this thing if it's an enterprise software? And what is their incentive to want to buy this thing versus what they've already bought? And you just begin to disaggregate it to see that at the end of the day, someone is saying, thank God this thing exists. Because as a consumer or as an enterprise, my life is better, easier, faster, cheaper, more efficient, more beautiful than it was before. And that's the way I think it plays out at the blue sky stage.
One of the things that I've really enjoyed seeing as I get deeper and deeper into the data is how many of the growth companies are run by not cool, hipster, young people, no offense to most of you on the call, but older people who came from industry, saw a problem, saw a challenge. And so when you're talking to a team like that, led by somebody who has managed a big P&L before, worked in a corporate, has, industry experience, it's easy to kind of evaluate and imagine them leading a company. With some of these awesome younger people who may not have industry experiences, but are coming across a challenge in a new way, how can that team present themselves in a way to prove that they're going to make this happen, especially earlier stages of testing and validating the business? What are you looking for in that team, and what kind of, especially for those kind of single founders that may be working with a couple of people when they're building their team, what are those attributes that you're looking for to know that these people are going to execute and come through for you?
So, I mean, just to come at it in a couple different ways. And first,
Sure.
by look, I've met people in their 20s who are stuck in the mud as any 70-year-old I've met. And I've met 70-year-olds who are more curious about what's happening in the world and how they can be a part of it than ever. And so, I do think, having said that with time, people tend to get into a rut of their patterns. And it takes, over time, you just start to have to check your narratives more and to be able to really reach out and sort of look at the world in a different lens. Because I have to tell you, my batting average with what I'll call, generously call entrepreneurs, and that is women and men who have worked in large companies who want to spin out and do new things, is very, very mixed. And it's not necessarily even that they're not curious or not interested. It is that if you've spent a long time, assuming a balance sheet is behind you, if you've spent a long time people answering your phone calls because the brand behind you gets your phone call answered, it is a new musculature to go out there and have people say, who the fuck are you? Like, why am I answering your call? Like, who are you? It's almost, it gets into your DNA. And by the way, I've known some people to do it. I'll tell you very bluntly that I was an entrepreneur who went to, and was an entrepreneur before that, but then became one again. And I think my first year of transition from entrepreneur back to entrepreneur was actually one of the weakest ones of my career, because I had to kind of get that DNA refocus. I had to get that edge back in, which goes to people who are doing it for a fresh way. I am looking for curiosity. I'm looking for people who are digging and asking the right questions. I'm looking for people who listen. But at the end of the day, and it's something you almost see in the eyes, which is why, for all the power of Zoom, once I get serious, I've got to see somebody physically, because they effectively just look at you and they're like, you can slow me down, but you can't stop me. And so sometimes I'll ask an entrepreneur, like, what are you going to do if this doesn't work? And you get a spectrum of answers. None of them are wrong, but they're all interesting, right? So one end of the spectrum is, no, it'll never be wrong. I've done all the homework. Of course, this is going to work, and I'm going to make it work. That's not necessarily a bad answer, but it also means, are you listening to the data and everything else? I have other people who say to me, look, man, I think this is going to work. I've laid out to you exactly why I think it's going to work, but here's the stuff I'm going to be looking for. If it tells me something different, I'm going to be able to leverage what I have to that area. That's also, a good and interesting answer. And I have other people who say, well, I'll go back to McKinsey. There's nothing wrong with that answer either. But at the end of the day, what we're really looking for is someone who's saying, I can do nothing else. Like, there's nothing else I want to do. This is what I have to figure out, and I am going to do it in a certain kind of a way. And I know there are things that I don't know, I hope I have board members who can help me think through some of the pattern recognition that can be helpful. But at the end of the day, I'm the one making the decision. And you know more about your business than 90% of the people who will advise you, or 90% of the people who sit on your board. And when you can find that 10%, well, that's a real valuable, both personal as well as a larger board that you can have around you.
So many of the companies that we've been talking to, including a lot on this call, have done some really creative things to be able to keep going without investment, meaning they may partner with an outsourced firm for this or this or this and give them equity. What's the balance with outsourcing pieces of the company to make it move? I mean, there are some companies that are outsourcing what might be key building blocks of the app or the platform. How do you reconcile that as an investor? What can be internal, what can be external? What's the balance there?
Your last observation is the one that always sticks in my head overall, which is, what is it you're outsourcing and to what end? And at the end of the day, I think very, very early on, the people may have a great idea, but they just don't have the engineering chops around them, and they'll partner with someone or what have you, and it's kind of out of necessity. But I can't think of many, there are exceptions to everything, but I can't think of many times that for a long period of time, a great company has outsourced what is core and foundational to their competitive uniqueness. I just haven't seen it. I'm sure it can happen at some times. And of course, you can use vendors going forward and everything else as you scale, as some of the greatest companies on earth do. But there is a core set of things that make you different than everybody else. And they're pretty hard to outsource, except maybe in the earliest days when you don't have any choice about it. And when in terms of giving up equity, look, remember this. Equity is your gold, and your investors will look at equity as your gold. It's the finite thing, right? You don't raise more equity. Equity is equity. And every piece that you give to someone is a piece that you're not giving to someone else who will be incented by it in order to take you where it is that you want to go. And sometimes it's a great trade-off to be able to go with a very small consulting operation. Sometimes those small consulting operations become your engineering company. So there are many ways to be thinking about it. But at the end of the day, constantly checking with yourself and saying, what is core that is making me distinct? What edge do I really control? And how comfortable am I in outsourcing that? Or when do I have to realize if I don't own it, I'm never going to really build the successful thing that I'm going to build? Has to be a question in it. Another little bit of vary on the theme, you didn't quite answer this, but this does, I see, happen later, is that entrepreneurs want to have, quote unquote, industry money invest in them. And by the way, that also can be fine. You can get some business deals out of it, perhaps. It may add a little bit of imprimatur, though I tend to dismiss that as a bigger case. The worry about bringing in, quote unquote, industry money is that they'll often put weight upon you. You actually think they'll unleash you, but they're actually slow moving. They make commitments to you, but the fact is you're rounding error upon what they're doing. So the execution of what they promise you may not be that great. And often they may try to put stipulations on you. So for example, yes, we'll give you a lot of money, you'll have our brand, but we get a right of first refusal if you ever sell the company, which means that almost any other future investor who either wants to buy the company or is looking at the company is like, all we're doing is setting a price for them. So even in that case, I'm not saying don't do it, but you want to go in with your eyes quite clear about what trade-offs you're bringing to bear and what realistic expectations you have about what they bring to bear, like what any investor might bring to bear to what you build.
Every answer is like perfect with a bow, Chris. This is great. Okay, next,
I've made a lot of mistakes.
Next one up. I know there are a lot of different formulas and philosophies around valuation, but when we're talking about seed stage, can you walk us through a couple of different ways to defend a valuation and to build a valuation in the first place? And then we can talk a little bit about when you actually start having revenue in, what that could look like.
I used to argue differently than what I'm about to argue now. I used to be kind of skeptical of the notes, and I thought it was kind of lazy and kicking the can down the street. But the fact of the matter is I still think they're a very efficacious way to get money in very quickly, where you don't have to get too tied up in this. You don't have to give away too much before you know what you have. I mean, obviously, quite often a cap, which is essential in a note, because I won't look at an uncapped note. Obviously, most investors won't. Well, some do, but a lot will not. Almost becomes a proxy for valuation anyway. And so you have that little bit of a dynamic of it. But all things being equal, kind of a reasonable cap with a note that sort of pushes us down to have a better handle of where you're going can be beneficial to both the investor, but certainly to the entrepreneur. If you decide you want to go the priced round route, what everyone does is they look at kind of comparative, they like problematically look through side view mirrors, but they'll look at comparative deals and their reports at TechCrunch and elsewhere and Crunchbase about what valuations of similarly related companies are. This has now become somewhat irrelevant in the time of COVID, or at least hard to figure in the time of COVID. They're publicly traded multiples that people will use of similar businesses. And you come to kind of a discussion and debate about what evidence that you can pull, often based on comparable basis, or where you think the company is going to be really going over time. But it becomes more of an art than a science. And I do think, all things being equal, a note is probably a better way to go earlier on.
And then for later stage, like you're getting to a series A and B, what is the most generally acceptable way to say, here's what and obviously industry wise, you have different multiples, but what could that look like so that we can start kind of narrowing down a path for being able to say, here's what I think the valuation may be?
You know, it is a combination, and this is what your venture capitalists are doing with or without you, right? All of them are going to be looking at comps. I mean, it is a big thing to say what other private deals are getting valued at what multiple of revenue, multiple of GMV, multiple of EBITDA, if they want to focus on profitability, whatever it may be. And again, they sometimes will bring to bear public transactions as well. But we're living in a world of such good data and information that you can really kind of pull up a lot of similar things. And, you know, particularly, honestly, Susan, an organization like you that has so much pattern and recognition around the globe can be very highly instructive on kind of what those ranges come in at. And then it becomes within that range of reason, it becomes a debate about why you deserve more. And it becomes a debate a little bit about, you know, what is it that you really are willing to give up in terms of control. With this caveat that I mentioned parenthetically before, but is important when you get to the A round and beyond to think about, we will sometimes really get all toked up about getting that big valuation. Obviously, it means mathematically, we, the entrepreneur, don't have to give up too much of a share of the company. It's really bragging rights. We all would love to be declared a unicorn, God knows, or whatever. It's all that kind of stuff. But you have to really look hard about the signal that you're giving, because I have invested in companies and I have had companies when I've advised them on this. Don't take that valuation, because I think you're going to have a hard time justifying it in the next round. And you lose tremendous amount of power in the next round if your performance really drops, you know, in a real way that makes the previous round look debatable. Not always, but it's an issue. And look, I think at the end of the day, the greatest leverage you have, particularly farther down the pike, is just getting more than one term sheet. And that is, I cannot emphasize it enough. And it's always sounds easier said than done. But even in the rising markets that I'm in, with more people investing, more funds have raised funds. They are larger funds than ever before. Direct investors are now coming in the market. In the case of many global markets, China is in the market. Family offices are in the market. Your ability to get more than one term sheet is probably better. Now, COVID is a different dynamic, but even now is probably better than any time in history. And I can't undersay or oversell that in the end will have the greatest impact on what your final valuation will end up being.
So what's that timeline like? Like, I know that for many of the people on this call, they're idea stage, early stage, it's seed. I mean, I know it can take months of finding the right people, but where do you start actually looking, and what does that timeline potentially look like, especially if you're sourcing potentially from virtual, new, making relationships from the beginning, you know, so not just friends and family. What are we looking at when we're, you know, finding people on LinkedIn where our business may fit their portfolio thesis, and then starting a real relationship of trust?
You know, the speed of the efficacy at the early stage is, it really is about getting money in as simply as possible. You need $500,000, $1 million, $2 million, whatever it is. And without all the other parameters and cautions that I've given throughout this conversation in mind, you just want to kind of get it done, because it can take months. I mean, if you have a great idea and if you have a track record, it may take a month. But if this is your first rodeo, and if you haven't built that kind of a track record yet in doing it, and there's some explaining to do, depending on your edge, it definitely can take a couple of months. But then every so often you can get really, really surprised about this, because when you get to the A round, it can very easily take 2 to 3 months, and we're talking pre-COVID now, right? And then I've seen this take 6 to 9 months. But more often than not, if it's taking 6 to 9 months, there's a challenge. There's something that's going on. There's something that's getting people stuck on, and it can become problematic. It may be valuation. It may be something about the operating company. It may be something unique to the proposition, but it is there. And so you really hope that from the time you start going for, say, the A round, that is within a 3 to 6 month period of time, you can get up in the morning, go to bed at night, getting it done. Most people who raise at the earlier round are trying to get enough cash, certainly to get them through a year of burn. And the cliche, but I think also true, is 18 months is good. And then it becomes a mathematical exercise as well of when you should start raising again. Because if you're raising with 3 months left, you've just compounded your problem, because your investors will know that. They will know that you're going to run out of money in 3 months, which of course changes the whole dynamic on what terms you will get and everything else that way. So it's a balance of sort of saying, look, I've got 18 months right now, and probably 3 to 6 months from now, I'm going to start the process. And some of it may be soft dating, some of it may be with a greater level of tenacity. But if investors see you have a year of cash with you, 9 months of cash in you, and you're doing great, and other people are interested in you, you'll probably be fine.
Interesting question. We've had a couple of speakers talk about not necessarily being 100% focused on one business. And so we have a question here from a beer. Will a multitasking entrepreneur, somebody managing 2 startups, have a strong case for getting investment? So how important is 24/7 focus versus somebody who might be a little bit more of a hustler in addition to being a great entrepreneur? What does that look like to you? How do you evaluate those type of people?
Different sectors in different countries certainly can be different about this. I mean, look, if you're a great entrepreneur from Africa, there's a pretty good chance. I mean, the average average Kenyan has 6 revenue streams to their family. I mean, they've kind of built it with a culture of thinking about that. And so it's possible that people may have a couple of side hacks, if nothing else, except that even in the emerging markets, I come from the theology that in your first rodeo, and certainly in the earlier stages, it is a 24/7 occupation. Now, we look at people like Jack and Twitter and what have you, and we look obviously at the juggernauts like Bezos. But when you start getting to a level of scale, you can start putting really full-time CEOs of unbelievable talent to running it, and then you're almost like a highfalutin board member. But I think early on, and people disagree with me on this, I want to look at a woman or man, even if it's their nature to be a bit of ADD. I'm ADD. I mean, even if it's a bit of a nature to be ADD, that they're still shaping their ADD around different kinds of activities can help that asset win. And so I can't tell you it's 100% that I would reject it on that. And if, for example, if I saw an entrepreneur who had 3 wonderful successes backed by blue chip people, each of whose company went through Y Combinator and did very well, and they have one project now that's 80% of their time, and they have something they're doing 20% of the time, I'm not saying no, but we'd be spending a lot of time talking about it. There's a company I invested in which has actually done well enough where one of the founders spent a lot of time on a nonprofit, not totally unrelated to the business. So I convinced myself at one level that there was some good shared learning there. But I have to tell you, if I could wave my hand, I would have rather have had that guy getting up in the morning, going to bed at night, thinking about only one thing at a time, particularly early on.
So let's talk for a little bit about advisors versus board members, because this is something that people really have a hard time getting their heads around. So you meet, a lot of us have access to really awesome people. How do you evaluate who might be a good advisor versus who becomes board members?
Well, the first thing you have to be clear on is that they're fundamentally different things, right? A board member is a fiduciary. A board member can be a great partner to you. A board member can be a great support to you. They can even be a mentor to you. Some of the best board members in the history of business have been great mentors. But at the end of the day, they're a fiduciary, which means their job is to the investors. And if you start falling off your performance, or if there are issues about your integrity concern or anything that comes up, their job isn't to mentor you out of it. Their job is to make sure that the train is running the way that it ought to be running overall. And so you have to just think about that kind of a distinction in what you're trying to get overall. By the way, you also over time will have limited control on what board members you will have. I mean, once you get to the A round overall, your investor will have at least 1, maybe 2 board seats. The investor may push for at least 1 independent board member, which means you and the investor figures out who that board member is, and you may keep yourself and maybe 1 other person that's quote unquote yours. So that will evolve over time, no matter how it is that you think about it. An advisor at the end of the day should be a woman or man of just great insight and execution for you with a very core understanding of what you hope from her. And this is a mistake I think that a lot of entrepreneurs and frankly a lot of advisors make, which is they're not really clear in expectation. And you could give a quarter of a point. I've seen advisors get a point or more early on from the companies because the value that they're expected to give is real. And by the way, if your advisor, for example, is great in inside sales, and this advisor is opening up 5 clients to you that put a few million in your pocket in your first year of operation, they're worth the point that you would have given them. The problem comes when you give somebody a quarter of a point or whatever, and it's not really clear what you hope to have for them. Now, if you really just want someone that you can call once a month and talk you off the edge, and that's worth a quarter of a point or half a point to you, there's nothing wrong with that. But at least you've been clear about the expectation of what you want. Advisor comp should vest, and you should have an ability, both should have the ability to say after a year, maybe this isn't the value that I thought I was going to be getting in it overall. But again, you have to start with the foundational difference between what it is that a board member is fiduciarily and what an advisor is as really kind of a compatriot and really just that, an advisor to a series of issues that you're wrestling.
So how does one start finding the right advisors to come on? We have a specific question here. At what stage, and how do I have someone at the earliest stages understand what I need from them and convince them to help me build my brand?
Look, I'm a little bit of a sucker. I frankly spend a tremendous amount of time with a tremendous amount of entrepreneurs and ask nothing for it in exchange because people did it for me. I think it's just a part of the ethos of who we should be. And I learn a lot, by the way, from it. And it's great. When I have found that when people really need a committed amount of time from me, then we do go have a discussion about it. And that can be at a very early stage, and it can be a very well-established company. Finding them really starts at the end of the day, often with just a personal relationship of a woman or man who, really can help you shore up things that worry you or shore up things about yourself that you know that you're weakness about overall. And over time, success breeds success. What you'll find is as your company begins to become successful and it begins to build a reputation, you will then, through other friends or yourself, go to people that you didn't know necessarily that well, who just love the idea, or who want to learn also from what a new version of what is going on going forward. Then you vet them the same way that we've been talking about you vetting a board member or board member is vetting you. You really want to make sure you're getting someone that you're simpatico with and simpatico with the culture, because they can make an enormous difference to you. There's a man who died not long ago who was sort of the archetype of the great advisor, who was also a great board member. And Eric Schmidt wrote a book about him. The guy's name was Billy Campbell. And I advise you to read it because Billy had no compunction to tell a CEO where to get off. Billy would literally sit in on company meetings and afterwards rip the entrepreneur a new one, effectively saying that that was a totally dysfunctional meeting. You're not seeing this, this, and that. But that's exactly what the entrepreneur wanted. And Billy, who'd also been a sports coach, among other things, did it in a very constructive way. And so it just really depends on what you want, what kind of style of engagement you want, and what you're really willing to pull the value from.
So now I have a board. How do I start to build the infrastructure to manage it properly so that I'm giving them the information they need so they can help me without getting too much intervention? I mean, you already warned us about some board members getting too involved. So what does good board management look like?
I think the most fundamental rule of business, generally speaking, but certainly in boards, for bosses, for the people that you manage, is no surprises. I think that their ability to have that level of transparency and openness, that when things are good, you can celebrate them, explain them why. And when things are going wrong or what keeps you up at late at night, you lay them out. And as you build confidence in the board, what might even begin in your early stages, weekly meetings, will certainly then become monthly meetings. All of a sudden they become quarterly meetings. And they take kind of a rhythm of their own because so much of the trust building has been built into place in that. I was hyperly, in the companies that I ran, I was hyperly transparent. So I sent a monthly letter to my board. We met at first, I guess we met monthly or maybe every 2 months, and then we were fundamentally quarterly. And certainly quarterly, we had a deck and the whole kind of presentation. But once a month, I'd send them a one-page memo of my reflections of where we are, specific asks of what I might want from them. And they were never surprised. There could be bad news. Sometimes things would happen that would surprise me, and then I would share it with them. But that dynamic became a very powerful one. And the logistics and the administration of who's taking notes and keeping records of it is kind of tried and true. And any investor can help you, make sure you keep that kind of thing happening, which is a very good discipline.
So we have a question around, is there a concern for an investor when 3 out of 4 shareholders are relatives? What does that look like? How do you view kind of friends and family being lots of family?
Every interaction of 2 or more people has its dynamics. And family brings a unique dynamic. As I alluded to before, knowing each other since kindergarten brings a dynamic. Working together brings a dynamic. And some of the dynamics are really positive and helpful, and some of them are stuff that can at times be problematic. And I think you just have to unpack it, and you have to talk about it very openly. To the degree that family is truly fiduciary board members, and I were to figure out that they kind of want the business to be run as a family business, and they would like it to dividend and do okay and sell, decently in 8 or 10 years, I have no problem with that at all. But it may not be the kind of company that I want to invest in as an investor. And so understanding those dynamics early on, I think, are very important, because, obviously Chapter 11 courts are filled with dysfunctional boards, who didn't have the dynamics set, who thought they could work things out but couldn't work things out. And that dynamic could come from a previous family situation, but it can come from many different places.
So how much do you look at current board members or advisors as part of your reviewing a company for potential investment? How important are they in the equation?
It's really important. I think at one level, they're part of my due diligence for sure. And I learn a lot about them as I'm also learning about the engagement. I'm looking for where there might be tensions or problems that have gone back, or inconsistencies that I've turned out overall. But look, at the end of the day, people are also people, and sometimes they're fantastically smart and even contributing board members who may have an edge to them or a style that's different from my own. But I realize the value that they're creating there, and I want to be in this company, and they're investors and they're there. And, it's becoming upon me to figure out to be a grown up and to work through it. And sometimes we'll get along and sometimes agree and sometimes we won't. And can we be respectful about it? I own that as well. It's not just about what you inherit. That's a lot about what you bring when you come in also.
So I have the last question here. So how do founders tell the story about landing their first customer or their first few when they're starting to show traction, to then help tell the story of the roadmap development? So sometimes, they have their MVP, they're getting traction with what they have, but it's not always necessarily as well tied as we'd like to the full roadmap. So how important is the early traction to roadmap development and telling that story in a coherent way so you get excited about that investment?
Well, the coherence of a story is always very helpful, but what is more helpful is the conversation that happens with pulling off the narrative about what you're learning and what you're seeing. And again, what you're really looking for is just the response of the entrepreneur. What is she thinking about? What is she learning about this? And at the end of the day, it's obviously very helpful to say, this is why I have this in my teeth and I want to solve it. This is why I have to solve it. This is why I think it's a big problem. This is why I think my MVP has got great product market fit for the very thing that I'm talking about. And by the way, I have 2 customers trying it right now. And here's the data of exactly what they're telling me. This has been confirmatory. This has been a little surprising to me, but there are only 2 customers. So I want to try this with the next 2 I'm talking about. And if I'm hearing a trend, obviously I'm going to start addressing it. It's that kind of a conversation. It's not just the meticulousness of 3 slides that hold together in a narrative. It is, what can you explain to me that you're learning and processing and evolving with the input that you get once you start to deal with the customers. And it's invaluable, because I can assure you, if I'm going to invest in you, I'm going to talk to those customers. And it is problematic, by the way, if you tell me something and the customer tells me something quite different. That's
problematic.
That is problematic.
I just got a bunch of really other good questions, all really fast. So we're going to do 2 fast last ones.
Okay.
Across your most successful investments, what have you seen as something similar across the ones that have really done well and gone for it and executed well?
The only answer to that is a cliche, and it's been absolutely, without a doubt, completely tied to the efficacy of the entrepreneur and the team she's built. Sometimes it's luck. Sometimes there are other things that happen that they are able to keep on top on. But the caliber of the entrepreneur who really understands what they're doing. You can't slow them down. They're willing to listen to data and they're willing to listen to insight, but at one point will take that data insight and make a decision and move with it, and having complete integrity and character in that process, and just move with alacrity. I mean, you see it in them. That is absolutely consistent. All other things, there are many things. And look, I invest from enterprise software to property tech companies to direct to consumer things. And so there are different things that are sometimes shared about their success, but it all boils down to the horse who's running it and the team that they've
Last question. What about Series A type level companies? They have history and a track record and they don't have a board. Have you seen that has been an important point of, as you start to look at them for investment, that they create that infrastructure? Or is that something you come in and start doing for them? What does that look like?
By the time an investor starts putting in real money, that investor, again, exceptions to every rule, they're going to want to be a part of the fiduciary ride. Like, they're going to want to see how their investment's doing. They're going to want to be on top of it in a regular way and have all the access to information and the pushback that is required in that. So if I had a great company that had a board of one board member or maybe no board members other than the founding team, and they were all signed up to, take this to the next level, and I wanted to do it, then I wouldn't have a compunction about creating a board. We would do it in that case for the first time, but that would not be, dispositive. I think in many respects, as I reflect about the amazing questions you've asked and your team, these amazing people around the world have asked, where things get really, really tough for an investor, like at the A stage and beyond, is really trying to figure out, is that great team that's gotten you here the same team that can get you to the next level? And that sometimes is a really interesting challenge, because some entrepreneurs are fantastic at startup. Some are fantastic to the A stage and can really go no further and actually don't want to go further. Some are really just by nature serial entrepreneurs. They want to do something for 2 years, get it off to someone, bring in a good management team and keep their equity, but move on to the next thing. And sizing that up, I think, and really sort of asking ourselves a question, will this person scale to the next level of what they're going after? And can we help them do that? That becomes, I think, much more of a gating question, and rather than have they had a board before, per se, an example of that.
That's a perfect way to end today. So I think a lot of that comes back to some of the activities we're trying to get you guys to do. It's really being honest with yourselves about your personal goals and where you want to take the company, because that authenticity of why you're doing it, how you're spending your time, the people you're surrounding yourself with, and making sure you're always laser focused on your customer problem instead of how you look, that really creates some problems for not just us as founders and sometimes as people who want to support you, but making sure we can matchmake you with the right people. Because I mean, when I say, oh, they'll be investors, and you're asking to meet with every single one of them instead of really understanding exactly what your need is, we can't help you. So the more honest each of us are with ourselves and our teams around what the goals are, that's the only way we're going to get them done. So Chris, I cannot thank you enough for your time today. This was great and really important for us to remember kind of why we're all here. And if we do have investors in our future, what we need to do today to make sure that we're prepared for it. So thank you again for your time. I look forward to catching up soon, and best wishes for peace and health and happiness with your family.
And to you all. Thanks for having me.
Thanks. Nice to see you again.
Nice to see you.
So
Bye-bye, everybody.
guys, we're going to answer some of the questions coming in about the next stages for EWC. Carlos, if you can pull up the slide again so that we can get that. Again, global pool versus national competition conversation keeps coming up. So we have a slide that explains every single country that is currently in global pool. 9 additional countries were added last week for global pool. So let's pull that up. So we have the country list there. And I saw a couple people asking about their specific countries. No, Argentina is not on it, etc. So if your country is on this current list, you will get an email. You should have gotten there already with exactly what you need to do on the EWC Accelerate platform to do the deliverables. You have additional deliverables that we're going to review to decide on the top companies to get into the global pool global finalists. So idea stage has 3 additional deliverables that need to be done by June 1. Pitch deck, OKRs, and the company canvas. Early stage has to update their pitch deck as well, the OKRs, and the user persona. And then finally, growth stage is going to do an OKRs exercise in addition to updating their pitch deck. So what does that mean? I've gotten a few questions also around video quality. You don't need to hire some TV crew to make a video for you. Use your phone. We're going to have your pitch deck already. Just talk into your phone. No big deal. We want to see how you present and what you're talking about and what you're bringing to the table. Ideally, you have your team there with you, or you can do it as a Zoom call. You can literally set up, record a Google Hangouts, send us the thing, and you can have your 2 or 3 co-founders in the video together. Low budget, super easy. We want to see you. And then you're going to update your pitch deck, because ideally you have some great updates for us from the last time you gave it in your application. That's what we're looking for. We're looking for, are you real? Period. Are you real? Are you going to bring it when you get on the stage? So there will be a last group of new countries that are announced as global pool countries in the next week or so. So when those come in, we'll give them an extra couple of weeks, but these are rolling reviews that are being done. The sooner you get them in, the easier it is for us to make sure that we can review it. And we're looking at every single one, reading every single one. I really care about transparency and accountability in this process. We're reviewing all of them. So make sure they're great. Like, give us 100%. T-Golf has not initiated any call. Okay, so T-Golf is up to their eyeballs in the tens of thousands of applications they're getting for India. So they will start regional competitions. They'll probably alert everyone in June for the whole timeline. It doesn't mean things aren't moving. My suggestion to you guys would be very simple. Go on EWC Accelerate, look at the deliverables. Whether or not you're in a national competition, you should do those activities, because judges are going to be reviewing you on many different aspects, including your deck and pitch, of course. Really review exactly what every possible scenario could be for a question they're asking. That's why we gave you these very structured activities to do for the deliverables. OKRs, no matter who you're talking to, you should know what those are. Your canvas, if you're idea stage, it'll help you think through every single piece of how to argue the opportunity you have in front of you. These are not, I don't believe in busy work. Get these done, whether or not it's part of your judging for your national competition, but it's mandatory if you're in the global pool, okay? The other thing that you can look to do is in your Slack channel for your country, reach out and see if your national organizer is putting the timeline together or what's happening there. We are all here to make sure that you get what you need done for the real world, not just the competition. Morocco has not yet been announced yet, but my assumption would be that there's probably already an organizer working on it, because Morocco has been a very, very good market for Jen and our partnership. So I'm pretty sure that there's a conversation there happening if there hasn't already been one finalized. So again, in the next week or two, we'll know about the last group of countries for global pool. Work on the deliverables either way. They will help you. What's an OKR? Hey, Abir, an OKR is an objective and key result. Objectives and key results. We have videos, templates. We have everything you need to figure out exactly how to do it in EWC Accelerates. So these are things that help you think through big picture. What do I want to achieve? What are all of the metrics and data I need to collect so that I understand step by step how I'm going to execute on my big idea? It's incredibly important for you to understand where you want to go and step by step how you're going to get there, because a lot of times whether it's for a judge, an investor, even partners. They need to know the roadmap you're trying to take so that they can work together in lockstep to all go in the same direction. So Carlos and Matthew, if you can turn on your cameras, are there any other things that have been coming up that we need to think about and answer for our teams? Carlos, anything else that you think is important to touch upon now?
Yeah, definitely. So there was a question that came in asking, will national competition have the same deliverables with the global pool countries? So just to reiterate what Susan had said, it's different and distinct. Every country in competition will have their own requirements.
Yeah, Carlos was awesome enough to make this chart last week. We'll also have this up on the EWC Accelerate document so you can see it there. But every country is going to have different requirements. The deck, the pitch time, etc., will be fairly standardized. It should be standardized. But in some countries, you're going to have semifinals and go through a whole process. In other countries, it might be just one national final. It really depends on how many applicants there are and the internal diligencing they do as a team to determine how many companies will pitch. In most of your countries, it's going to be totally virtual. So the time it's going to take for you to perfect your pitch is going to be pretty serious. But more importantly, the time it'll take you if there's a series of semifinals, finals, etc., really important to make sure you're in touch with your national organizer. They will reach out to you with deadlines, schedule. We know that some of the national finals will be as soon as mid to late June. Others may go through August. So just understand, however large your country pool is, that's what the national organizers are dealing with right now. And it's going to be really important for you to, hopefully they'll be in touch soon, but know if your country is not on that current country list or won't be listed in the global pool list that's coming out in the next couple of weeks, things are cool. People are reviewing applications. There's a lot of applications, which has been great. But that's why we're doing these workshops, guys. It's making sure that you understand this is so much more than a competition. And another way you can get involved right now, get on the discussion board we have on EWC Accelerates. You can put a question out there. Hey, does anybody know somebody to help me learn about this market? Hey, has anybody seen an interesting conference coming up that's run virtually on fintechs or agritech or whatever? Get to know each other. You may find incredible partners that could be on the other side of the world that can be that long lost partner, supplier, even customer that you're looking for. So use this to engage. Take advantage of the fact that if you're not preparing for a national final right now, go make sales. Go learn. That's what this time is all about. Matthew, is there anything else you want to add? You've been so awesome making sure everything works well. I mean, our whole EWC team from Gen Accelerates has been manning the discussion board, making sure these webinars are smooth, making sure that your QA is handled before things crash. Anything else you want to share with us, Matthew, that may be helpful?
I would just echo what you just said about the discussion board, but to be a little bit even broader with it. Just last night, we had a participant ask some very good questions about one of the deliverables for early stage. They wanted to know if for their video submission, if they should have done it in person or if they should have recorded their deck and done the audio over it. They also had questions about OKRs, how many should they have submitted? And I think amongst all of the different avenues that participants have to get their answers, their questions answered, the discussion board is a really good place because once you post it there, then everybody can participate and everybody can see the answer too. So it's not just private between yourself. Everybody can share in that knowledge gained from asking those really good questions. So use all the resources you have. The discussion board is a really good place. But don't be afraid to, kind of explore a little bit more and engage with the wider audience that you have there.
And on Slack. I mean, we have all these different ways to engage. And I just want, Paula, Yehuda, put up your cameras. I just want to introduce you to this team that's been working so hard for you. So Carlos, who is, oh my gosh, he doesn't sleep. I don't know what he's doing, but he's from Ecuador. Matthew's from Jamaica. Paula's from Colombia. Yehuda's from Argentina. Oh no, Mexico. Where was he actually born? I know he's like world traveler guy. He's probably not even on right now. That's why his camera's not on. I'm just kidding. We have an international team that's here to support you. There you are. Mexico or Argentina?
Argentina.
Ah, yes, I knew it. Why did I question myself? That's actually a great lesson for all of you. Go with your gut. Don't question yourself. But this is an international group, and we're really, really excited to be supporting you from all over the world. I think Carlos actually thinks he's Middle Eastern, because I think if I left him in Saudi or Bahrain or somewhere, he'd be just very, very happy saying inshallah every day. The point is, we're all here for you. So bring it, guys. We're happy to have you on these calls. We're happy to bring you great speakers every single week. But at the end of the day, this is about you building actual companies to support more and more and more of your customers all over the world. This is not just about the competition. So all these resources we're bringing, make sure you're thinking through, how do I make my business better today? That's what we're focused on every single day, helping you make your businesses better every single day. And we're super happy to be doing this for you every week. So you know what? Good night, get back to work, and we'll see you next Tuesday. We're really thrilled that we get the great speakers we do, and it's because we all believe in what this is about, building great companies that solve the world. So have an awesome week. We'll see you next Tuesday. Thanks again. Bye, guys.
Bye-bye.
Bye, everybody. Thanks.